Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing an important update about the economy and the investment markets so you can understand what we see in the global landscape. You know, it was an interesting day yesterday. Of course, the Fed minutes came out and basically talked about the Fed tapering. This is the bond buying program that they've been going on for basically well over a year. This is where the Fed essentially is buying $85 billion worth of essentially mortgage-backed securities to bring down rates, not only on mortgages, but generally speaking across all fixed income. We hit lows in this about 2 months ago. Since that low in interest rates, basically rates have moved steadily up as signs that the Fed was going to basically curtail their bond buying purchase. All this means is they're not raising rates, they're going to basically buy less bonds, which will bring up the short-term, intermediate, and long-term rate just a little bit. And as we've already seen about a 10 on the 10-year Treasury. We're back up to about a 3% yield. What this has basically done to Treasuries, if I look at intermediate or long-dated Treasuries, they are down around 15%. That's 15% negative year to date. While the equity markets in the U.S. are generally up, depending which one you look at, around, let's say, 10 to 12%. The Treasury market, Treasury bonds, the safest investment supposedly in the world, is down around 15%. So what I'm trying to educate investors about is this, and I've talked about this for months. What investors perceive to be safe, muni bonds, treasuries, or bonds in general, are actually, in my opinion, and I've said this repeatedly, one of the riskiest assets out there because rates are so low. I firmly believe interest rates will slowly move up over the next 3 to 5 years, probably between 1/4 and 0.5% a year. If they go up 0.5% a year, you could pretty much be guaranteed that if you own traditional bonds or bond mutual funds, traditional ones, that you'll probably either be flat or not make any money a year, or actually be negative depending on how fast those rates go. Remember, when rates go up, bond values go down. At Resney Wealth Management, we are in floating rate securities right now. These are short-term paper. They don't have the impact of rising interest rates because they're so short-term in nature, and I've talked about this before. So we're on the right side of the fence, not on the wrong side of the fence, and I see too many investors who call our radio show and our TV show are on the wrong side of the fence because they don't understand what they've been sold by Mr. Broker. So again, we are a money management firm. Our biggest thing is not to outperform the market each year. Right now, we are, as always, more interested in risk management and making a return on your money. Year to date, across the board, all of our portfolios since the beginning of the year to today are positive. Okay? At the end of the day, risk management is going to be important. Our global tactical opportunity portfolio strategy, our relative strength, has worked extremely well this year in avoiding major risk. I'll give you an example. Again, we're in areas of the U.S. marketplace, the equity market, that's been relatively strong, and fairly, for the most part, we've been completely out of, at least for the last couple months, and the majority of the year, out of emerging market equities. Emerging market equities, to give you another idea, on average are down between 20 and 25% negative for the year, while a lot of the U.S. market sectors are up 10 to 12% for the year. Again, by running relative strength, owning what's relatively strong, and selling things that are starting to get relatively weak, helps protect against major catastrophic losses. Not these 2 and 5% up and down movements you're going to see every single day in all sectors, but these 30, 40, 50% drawdowns. We are interested in capital preservation. We're interested in risk management. We're not worried about little short-term 2 and 5% fluctuations. That's going to be commonplace, whether it's a conservative portfolio or a growth portfolio. What's interesting is this. If I look at the U.S. market and the U.S. economy, it's slowly getting better. In fact, some of the signs on PMI that came out in Europe, they're starting to come out of the recession. That's a positive. There was a flash PMI coming out of China last night that also was positive. Generally speaking, the U.S. has been the safest bet to be in this year. That's not going to continue forever. And when the U.S. starts to slow down on the equity side of the market, not the economy, but the performance of the equity market will start to rotate and shift into what's relatively stronger. That may mean someday in the near future, whether it's a month or a year down the road or 2 years or 3 years, we may start shifting assets back in the emerging market. Not at highs, but at extremely low valuations, which will give us great opportunity for growth. Again, relative strength works. It basically puts you into relatively stronger areas and takes you out of areas that are starting to get relatively weak before they're down 30, 40, 50%. I believe it's an important strategy investors need to understand. Every year you're not going to outperform. If you're more interested in growing your portfolio and income and you want risk management, that's exactly what the Global Tactical Strategy is designed to do. And it will, from time to time, have great outperformance. I feel that could be near, and I feel that as we progress through 2013, I think investors who have a disciplined approach, like Resney Wealth Management, are going to be the big winners. At the end of the day, a sound investment strategy is going to trump all instead of emotions. I continue to get an enormous amount of phone calls from my radio and TV listeners, just emotional investors about the world coming to an end, about this and that and why they shouldn't be invested. Folks, emotions are not a great investment strategy, and it's a bad way to pick your investments. Running a strict strategy is more important than ever, and I firmly believe risk management is important. The U.S. economy is getting better, not as fast as anybody wants. There's always going to be headline news. Remember, I try to teach investors, turn off the TV. Unless you're managing your own money and you're in front of that computer 8-10 hours a day and you're really studying the markets and really running your portfolio, looking at your account every couple minutes online is only going to drive you nuts. And listening to the talking heads on TV, the news, or the noise I should say, about buy this, sell this, do this, is only going to hurt your portfolio. And it's also going to ruin your sanity. At the end of the day, if you're a client, give us a call if you have a question about your portfolio. If you're not a client and you want to become a client, call our office for a consultation. We always like taking on new clients who want to better their situation. We do have a live show this Sunday, of course, on our radio. And of course, we have our TV show that's going to replay this Sunday night. Go to my website, resneywealth.com, for times and availability. And make sure, again, you have a safe and profitable day.